Warren Buffett never had large investments on Canadian stocks. Neither is he a fan of international stocks. He does have some foreign investments, but nothing substantial or comparable to his US investments. Buffett prefers to stick with his comfort of zone, which is the US stock market. He did invest in 3 Canadian stocks once upon a time. Let me give you some numbers about Suncor. The market capitalization of Suncor is $35 billion during the recording of this video, whereas its total assets sit at $89.4 billion with equity of $42 billion. Equity is essentially a company's total assets minus its total liabilities, and this value would be the returned value to a company's shareholders. If all the assets were liquidated and all the company's debts were paid off, this value, the difference, is what we call the equity. As you noticed, Suncor's equity is much higher than its stock market value, and this is a very positive factor. For us to have a better understanding, let us compare Suncor with other companies. Pembina is another Canadian company in the industry of oil and gas. Its market capitalization sits at 22.21 billion Canadian dollars. As of end of 2020, its equity was sitting at $11.8 billion. As you notice, its equity is only half the value of its market capitalization. Therefore, this is a suggestion that Pembina is overvalued. But we will not make any conclusion based on the market capitalization and equity alone. Let us look deeper into this company. Pembina's book value per share in the trailing 12 months sits at $25.90 per share, whereas it's currently selling at $40.21 per share. Hence, with these numbers, suggest that Pembina is much more expensive than its intrinsic value. Now let us have some diversification in our comparison, shall we? Let us compare Suncor to a tech company called Cisco. Cisco is another company that does not require any introduction. Yes, I know what you're thinking and I can read your mind. These two are absolutely different industries with very different ways of allocating expenses and very different ways of operating. But you see, I only have so much amount of money that I can invest. I do not have an infinite amount of money like Warren Buffett, and therefore, before I invest, I try as much as I can to ensure that I am investing in the best company I can evaluate. And that is just how I want to look at it. Now, moving on, we have to remember technology companies do have higher margins, lesser capital expenditure requirements as compared to an integrated energy company such as Suncor. And technology is a high growth industry as well. Therefore, it is safe to say that Cisco have got many advantages when it comes to industry norms. Cisco's market capitalization in 2020 was sitting at $243 billion US dollars. Its total assets as at end of 2020 was almost $95 billion. The equity of Cisco was sitting at $38 billion US dollars. If you notice, neither the assets nor the equity of Cisco is equivalent to its market capitalization. Cisco's stock market value, which is $243 billion, is more than double the company's assets, which is sitting at $95 billion, whereas Cisco's equity is almost 7 times lower than its market capitalization. Therefore, in theory, if the company is to liquidate, shareholders will not get what they paid for. Furthermore, Cisco's book value per share is $9.78 US dollars per share in the last trailing 12 months. But currently, this company is selling at $58 US dollars per share. Cisco is essentially trading 6 times more expensive than its book value. Some of you may ask, so what's the importance of book value? What we want to see in a company's book value is for the figure to be close or even higher than its stock price. This is a suggestion that the company is fairly valued or is undervalued. This Cisco figures therefore suggest that Cisco is an expensive buy. This kind of comparison is another approach I use to evaluate and understand companies. By the way, I use Stock Rover on my valuations. So far, it's the most detailed and full-packed platform that I have encountered. If you like it, you can have a free trial. Just click the link in the description box. So those are my comparisons on the value of Suncor compared to other companies. For one, Suncor is currently selling at $18.26 a share. The book value of this company in the last trailing 12 months is $19.70 a share. This is a strong suggestion that Suncor is selling for a discount because the book value is higher than the stock price. The second reason could be that the oil prices are forecasted to increase to $60.74 per barrel in 2022 and $65 per barrel by 2023, according to the U.S. Energy Information Administration, or EIA, thereby making margin and profits desirable for oil companies such as Suncor. When the pandemic hit in 2020, Suncor did not issue any new equity nor increase too much debt. This is a strong suggestion that Suncor is a financially healthy company. Much like the rest of the companies in the industry, yes, Suncor was affected by the global lockdown, but it is set to recover in 2021. One thing I wanted to mention though is the 2014 oil crisis, when the cost of oil was sitting at $107 per barrel by the first half of 2014, and this dropped to $44 after 7 months. This was in January 2015. This was a 59% drop. Suncor did not fully recover from that crisis as yet. Suncor has got enormous amounts of assets with 26 years of lifespan. Suncor is not only an oil and gas company but an integrated energy company. An integrated energy company means that the business entity engages in the exploration, production, refinement, and distribution of oil and gas, as opposed to companies that specialize only in just one segment. Therefore, Suncor has got an overall authority in all aspects of the oil and gas production. And this overall authority in all the segments in the oil and gas production makes the company truly powerful. It also has various assets that are situated around the world, not only in Canada, but in Norway, in UK, Libya, Syria, US, and the North Sea. Suncor is an asset-rich company. Not only this, Suncor also pays consistent high dividends. In the last 10 years, the company grew its dividend pay from 40 cents a share to $1.68 a share in 2019, but then cut the dividend pay during the pandemic, but still paid dividend despite the global lockdown. As you see on this table here, the company paid a consistent, stable dividend payout growth for 10 years. With the world slowly opening up, people start traveling and driving again, and with the forecast that the price of oil will surge in the next coming years, Suncor is indeed positioned to maintain its consistent high dividend pace. If you believe that Suncor is worth investing in as well, make your own research and your own due diligence. Do not invest or buy a stock of a company or any company just because you watched one video. Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.